Well, it's 5:30 in the morning here in beautiful Bangkok, having a Coffee Works espresso, of course, and I hope you're having a great day. Today, we're going to talk briefly about the book, Stocks for the Long Run. This book is amazing. I've always loved this book, and I just got this newest edition. And I want to cover some of the points of this newest edition. So let's look at that for a moment. And the book's called Stocks for the Long Run by Jeremy Siegel. And in fact, uh, this is the sixth edition. So the question I want to ask is, what long-term return do you expect for the U.S. stock market? Now, I'm not talking one year return or something like that. We're talking about long-term, over 20 years, 50 years, 100 years. What return do you expect? So that's a great question to think about. And this book helps us to answer that. I want to tell you the punchline here. In Siegel's book, Stocks for the Long Run, he tells us to expect a 5% long-term real U.S. stock market return. I bet you that wasn't the number that you were expecting. Probably were expecting something higher. Let's go into this. And I'll tell you that I became a finance teacher in Thailand in 1992. There's me, in fact, only a couple of weeks after I arrived at the teacher's office at the university. And I started as a financial analyst in 1993. And there's me as an analyst giving a presentation. And basically, Siegel's book came out in 1994. And it was really one of the best references available at the time. And now it's out in its sixth edition. This is the best data that I can find on the stock market. There are other sources of data, but the way he talks about it is fantastic. So I thought that I would take some time to go through this data to explain what I'm seeing. The first thing is we want to look at nominal returns. Whenever we think about the stock market, or stocks or bonds or whatever, we almost always are thinking nominal returns. That's just the number. If the stock was 100 and it went up to 110, it was a nominal return of 10%. But what if inflation was, let's say, 10%? Then we had a real return of zero. And so we start with nominal returns, and this chart that I'm showing here goes back to 1901, which is, 1801, which is what part of the beauty of his work is that he goes back so far in time. And his conclusion is real nominal return for stocks was 8.4%. Now, what does that mean? That means that over about a 200-year period, you would have gotten a return in the stock market of 8.4%. Now, that's assuming, of course, that you stayed in the stock market the whole time. Also, bonds yielded 5% during this period. Bills, meaning short-term government debt, yielded 4%, gold 2%, and CPI was about 1.4. Now, the next chart I'm showing is this chart showing the same exact data, but on a real return basis. So now I just want to go back to the nominal return and look at the stock number up there. I'm going to grab my pen here for a second. And let's look at that stock number. And you can see that $1 grows to be $54 million over this 220-year period. But if we take out the impact of inflation, in other words, we look at U.S. real returns, $1 becomes $2 million. Now, still, that's a huge increase, and that is relative to the increase in inflation. So that's a pretty good story right there. So I'm going to have, you can download this chart deck for free by clicking on the Get the PDF link at myworstinvestmentever.com, or by clicking the link in the description. I'm going to try to have it up in the next few hours, so it may take me a little bit of time to get that up. But okay, let's look at this in more detail. I want to look first at more than 200 years of return. That's from the post-revolution U.S. Revolutionary War with England at the time until today in 2021, which is where his data stops. That's a 219-year, let's say 220-year period. What do we see? The first thing we see is this very low inflation period of about 1.4% average annual inflation. What we can also see is that stocks returned about 8.4% over that period of time. Now, if we back out the impact of inflation, we get to 6.9%. Now, US long-term bonds yielded 5%, so bonds are almost always going to be lower. And when we're talking about bonds right now, we're talking about government bonds. They are 5%, and if we adjust them for inflation, they're going to yield about 3.6%. And then there's US short-term bonds, which were yielding nominally about 4%, and the real return was about 2.5. And finally, gold, over this 220-year period, gold didn't really return that much. It was only 0.6% average annual return. So clearly, stocks were the best in this grouping. Now let's look at 95 years of return. We're looking at the post-World War I era from 1926 to 2021. What we can see is higher inflation. Now inflation's gone from 1.4 up to 2.9, and higher nominal returns for the stock market from 8.4 up to 10.2, but only slightly higher real returns. You see, real returns were 6.9 for the full period, and just for the latest 95 years, it was almost the same at 7.1%. This is why it's important to understand the real return, because the real return is what really matters over time, so that you're outpacing inflation. So you can think of that 7.1 real return as the amount that you've outpaced inflation. And now let's look at government bonds, US government bonds. And what we can see is that we got slightly lower real long-term government bond yields. So inflation went up, and it really ate into the performance of long-term government bonds. Their real returns was about 2.6. And this is what you can see, is that stocks generally are able to adjust up and down in relation to inflation, but it's harder for bonds to make that adjustment, particularly just simply because they have a lower return. And therefore, higher inflation basically destroys the value of a fixed income type of instrument like a long-term bond. We can also see that short-term government bonds actually went almost to zero. So a high inflationary period, owning short-term bonds, you're basically almost going to just get 0% return. In this case, it was 0.8. Now, 0.4%. And then finally, what we can see is in a higher inflationary environment, gold tends to do well on a real basis, outpacing inflation by about 1.8%. Now, let's look at a shorter time period. This is post-World War II. I meant to say I wrote World War I, but it's post-World War II, Bretton Woods, and it's 75 years. This is when the dollar was set as a standard. What we can see first is that inflation shot up to 3.7%. So for the last 75 years, it was at 3.7. And of course, stock returns also went up because inflation went up to 11.3. But on a real return basis, stocks didn't change that much. They went up to 7.3. Again, we want to look at those real returns. What happened to long-term government bonds? Again, higher inflation drives down the real return. So real long-term bond returns were down from 2.6 for the last 95 years down to 2% in the last 75 years. And that's the impact of inflation. And we can also see that higher inflation crushing the yields, the nominal yields of US government short-term bonds from 3.9 down to 0.2%. In other words, again, you're close to earning nothing. You're just keeping up with inflation when you invest in US short-term government bonds over that 75-year period. And again, with high inflation, we can see that gold's real return was about 1.6. It's important to mention here, and I'll just highlight that what I often say about gold is it's a terrible long-term investment. You'd much rather have your money in stocks than in gold. However, during inflationary periods, gold tends to perform well. And also, I would say that when stock markets crash, gold doesn't have a high correlation with the stock market. And therefore, gold can sometimes provide protection in a falling market. But for anybody that says, well, my strategy is to own gold for the next 20 or 30 years. Yeah, there's an argument for that. Let's say if the US dollar is going to collapse. In fact, this morning on my uh, phone, I saw that Fitch has downgraded US government bonds. And so there's been a slight downgrade for US government bonds outside of America, I believe, because of the foreign exchange risk. So yes, gold has some benefit if the US dollar was to collapse, but keep in mind that the number one asset to own ultimately over the long run is stocks, because stocks, as we can see right here, stocks real return over the last 75 years has yielded 7%, and over the last 219 years has also yielded about 7%. So let's now look at the final period, which I just decided to look at post-dot-com bubble period. And also I would call this globalization period. Globalization ultimately led to inflation to fall down to 2.3%. And also we can see real returns in the stock market came down to about 5.2%. Part of that's because we're starting at the peak basically of the dot-com bubble, and that was a massive bubble, and therefore it's hard to beat that and get strong performance. And that's the reason why it's 5.2% on a real basis. And then we can look at long-term government bonds, and rates came back up at that time. And we see that real long-term government bond rates came up to about 4.6 thanks to falling inflation. So again, falling inflation is beneficial for government bonds. And now we can finally see short-term government bonds never really saw their yields increase. In fact, because the Fed has kept interest rates at zero since about 2008, which is a large portion of this period, we can see that short-term interest rates were averaging about 1.5 on this period. And that means that you would have gotten a negative real return if you were investing in short-term government bonds. And this just goes to show that when you see long-term rates rising, as we see in this chart, compared to 75 years. So what I'm seeing here is if I look at nominal rates over the 75-year period up to the 21-year period, we can see for the 21-year period, nominal rates went up from 5.8 up to 7%. But we can see that short-term rates actually fell. And why did the short-term rates fell? Because of Fed coming into the market. And this is an important thing to remember. It's interesting to go back in time. When I started as an analyst, nobody was talking about the Fed this, the Fed that. But now we have a situation where the market is ultimately determined by the Fed. Now, that's crazy. That's not capitalism. That's government intervention. And who has the most power in this situation? The US government, because it has the reserve currency and the printing presses, and it can relentlessly print money and inject that money so that that US government can spend without damage to the currency. Now, someday that's going to come, but for right now, the US has managed to spend an enormous amount of money and finance it almost all by borrowing. So if we come back to this, one of the things that you can see is over this 20-year period, actually of 21-year period of globalization, you would have outperformed on a real basis if you had bought gold. Now that's fascinating. Basically, that doesn't really fit into things, because what you can see here is that the inflation rate actually fell, which would normally tell you that gold would perform poorly. But there was a lot of political risk going on in the US. And that's, I think, why we saw gold so strong. Let's wrap up what this discussion is. And I'm going to talk more about this book over time. But Siegel's advice is this: over the long term, an investor has paid about 15 times PE for about 6 to 7% after inflation stock market return. And in the future, he tells us to expect to pay about 20 times PE for about 5% after inflation return. That is it. If you're thinking about the future, Siegel is telling us, after all of his research, he's telling us that you should be expecting after inflation or real return of 5% in the stock market. That is a very low number. Remember, you can download this chart deck for free by clicking on get the PDF link at myworstinvestmentever.com. I'll also later try to put it into the link below. If it's not there in the first 3 to 6 hours from when this video comes out, I'll have it up very soon. I want to thank you for joining this session, and I hope that you get as much joy from Siegel's book as I get from it. It's been amazing, and an amazing book. Have a great day, and I will see you on the upside.